Warren Buffett pays a lower tax rate than his secretary. I'm not a financial advisor, but this is something that has been on my mind lately. I have two thoughts. One is that I know people who work very hard and earn a decent income, but they pay more in taxes than Warren Buffett. And the second thought is, well, I guess that's just the way it is. But then I started looking into this, and it turns out there are ways for almost all of us to pay less in taxes. The ultra-rich use structures, not loopholes. That means legal ways to minimize your tax bill. And today, we're going to walk through 3 of them. Trusts, borrowing against your stuff, and tax deferral. So we'll break down how billionaires legally minimize their taxes using structures, not loopholes. So let's dig in. Alright, here's what we know. Billionaires pay less in taxes as a percentage of their wealth than you do. It's not because they take advantage of loopholes or don't pay their fair share. They use structures. Here are 3 examples of the most common ones. First is trusts. So trust is when someone sets up an entity to hold assets and can specify exactly how and when those assets are to be used. There are many types of trusts, but for our purposes, we'll cover the 3 most popular. An irrevocable trust is one way to get money out of your taxable estate. Think of it like a gift that keeps on giving. Once you put assets into an irrevocable trust, they're no longer yours. They belong to the trust. And since the trust owns the assets, it will pay taxes on any gains, but only at the trust tax rate. The trust tax rate is always lower than the top marginal tax rate, which is what you and I pay. That means if you put $1 million worth of appreciated stock into an irrevocable trust, the trust would pay long-term capital gains tax on that million, which is going to be around 20%. If you sold the stock yourself, you'd pay income tax on the full amount and potentially face the dreaded 37% marginal tax rate. Irrevocable trusts also help with estate planning by removing assets from your taxable estate. When you die, your estate pays estate tax. Well, actually, your heirs pay the estate tax, okay? They're the ones who owe the government the money. The estate tax exemption is currently set at about $12 million per person. So as long as your assets are less than that, you won't owe anything when you die. But if your assets are more than that, you can set up an irrevocable trust to hold those assets, and they'll pass to your heirs tax-free. That means that when you die, your heirs will owe less estate tax overall and keep more of your wealth. Now, there are some downsides to irrevocable trusts. Once you put assets into the trust, you can't take them out without the trust's permission. And if you need to use the assets, you'll have to convince the trustee, which could be you, to approve the distribution. Also, once you set up the trust, you can't change its terms. You decide later on that you want to leave specific assets to certain family members. Too late. Those assets are no longer under your control. That's why it's important to plan ahead and make sure that the terms of the trust are clear and that everyone involved understands them before setting up the trust. Irrevocable trusts aren't the only option though. You can also set up a revocable living trust or a charitable remainder trust. These trusts have more flexibility but come with their own set of rules and regulations. It's important to choose the right type of trust for your needs. Working with a financial advisor or an estate planning attorney can help you figure out what works best for you. Ultimately, these trusts allow the ultra-rich to keep more of their wealth within their family and for future generations. It's a win-win. Now, let's talk about borrowing against your stuff. It's kind of like taking a mortgage out on your house, except instead of owing the bank money, you owe yourself. This is called a self-directed loan or a qualified personal residence mortgage. Self-directed loans let you borrow money against the value of your investments or other assets and repay yourself over time with interest. Here's how it works. Let's say you have $100,000 worth of stocks and you want to borrow against them. With a traditional loan, you will put up your stocks as collateral, but with a self-directed loan, you don't have to do that. Instead, you just promise to repay the loan based on the value of your stocks. Say you want to borrow $20,000. With a self-directed loan, you would pledge your $100,000 stock portfolio as collateral. Then you would write yourself a check for $20,000 and deposit it into your brokerage account. Then you could sell some of your stocks to cover the cost of the loan. In this case, you would sell 20% of your portfolio or $20,000 worth of stocks. So now you have cash in your brokerage account to cover the loan, and you still own all $100,000 worth of stocks. That means that you didn't have to sell any of your stocks to get the money you needed. That might seem like a small distinction, but it's really important because it lets you keep more of your investment gains. Say your stocks go up in value by 50% while you're paying back the loan. If you had to sell some of your stocks to get the money, you wouldn't benefit from the increase in value. But with a self-directed loan, you still own all of your stocks and get to keep all of the gains. So what are the benefits of this? For one, you don't have to pay taxes on the loan itself. You're just paying interest on the amount you borrowed, okay? Plus, you can deduct the interest as an expense. So it's like getting a tax deduction for borrowing money. Second, you can use the money to invest in more things that appreciate in value. Say you use the loan to buy a piece of equipment for your business. Equipment goes up in value by 50% while you're paying back the loan. You get to keep all of the gains, unlike if you had taken out a traditional loan and had to sell some of your stocks to get the money. Third, you can borrow more money. With the traditional loan, lenders look at your credit score and income to decide how much money you can borrow. With a self-directed loan, you don't have to qualify for the loan. You just have to have enough investments to secure it. Fourth, you can get better interest rates because you're essentially lending money to yourself. You can often get better interest rates than you would on a traditional loan. Finally, it gives you time to pay back the loan. Say you have a windfall and you're worried about getting taxed on it. You can take out a self-directed loan to buy an asset and then pay back the loan over time. That way, you don't have to worry about being taxed on the whole amount all at once. Okay. Now there are a few downsides to consider. First, you have to have enough investments to secure the loan. Second, you're borrowing against future gains. Remember, if your stocks go down in value, you'll have to sell some to pay off the loan. Third, you have to pay interest on the loan. That could eat into your profits if you don't use the loan to make more money. And fourth, it can be complicated. Setting up a self-directed loan involves a lot of paperwork and legal fees. Plus, you have to keep track of the loan yourself. You won't have a bank or a lender to call if something goes wrong, so it's not for everyone. Finally, let's talk about tax deferral. Tax deferral is another way the ultra-rich minimize their taxes, and it is a strategy that anyone can use. The idea is simple. Just delay paying taxes on your income until you're in a lower tax bracket. There are several ways to do this. First, you can invest in retirement accounts like 401 kiloseconds and IRAs. These accounts let you invest money and defer paying taxes on it until you retire. Second, you can set up a home equity line of credit and borrow against your home's equity. You can use the money to make investments that will hopefully grow in value, and you won't until taxes on the money until you pay it back. Third, you can own a business. Business owners can take advantage of tax deductions for starting a new business or investing in new equipment or hiring employees. Those tax breaks can add up to big savings. Fourth, you can donate to charity. When you make a charitable contribution, you can deduct it from your taxable income. That can lower your tax bill, and you can feel good knowing that you're helping out a cause you care about. Fifth, you can buy life insurance. Life insurance companies offer tax-free loans that can help you pay for college or other expenses. And finally, you can use installment sales. An installment sale is when you sell an asset but agree to receive the payment in installments over time. You only have to pay taxes on the portion of the sale that you receive each year. So when you sell an asset, you can elect to receive the payment in installments rather than all at once. That way, you can spread out your taxable income over several years rather than having to pay taxes on the entire amount all at once. Each of these methods let you pay less in taxes. Some are more complex than others and may not be right for everyone. But remember, the ultra-rich use these techniques to keep more of their wealth. And if they can do it, so can you.